welcome to the Capital Discussions Roundtable. I'm Tom Nunamaker, and today I'm presenting, which is kind of nice. But before I do that, a quick disclaimer that Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you, and we're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer-simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. So with that out of the way, welcome everyone. Let's see. Get rid of this. And as you can see from my title slide, we're going to talk about the Reverse Harvey today. And it didn't have a really good way to show Dan in reverse, but for those of you who don't know Dan Harvey, he's a good friend. Jim and I also knew him from the shared mentoring community. Dan was a mentor there, but he was written up in Technical Analysis of Stocks and Commodities magazine for being the king of the Iron Condor, I think it was. So anyway, he's been trading a long time, and I'll go through the story of the Reverse Harvey, but this is just a quick intro. If you don't know Dan, that's his picture. I took that when he was visiting us in Trier about 6 years ago. So there's a disclaimer I just went over. If you do want to download the slides, I have a shortcut link there, cdurl.us/RH for Reverse Harvey, and I think all lowercase will probably be the right way to do that. So let's get into this. The problem with butterflies, and the Reverse Harvey was originally to solve a problem with butterflies. So as time passes for a profitable butterfly, it becomes more sensitive to large price changes. And we've seen that as we get closer to expiration with the T+0 line getting more curvy. And doing nothing with a profitable butterfly has risk that as the gamma increases exponentially over time, your delta is less reliable, and big price moves in the underlying can turn a profit into a loss, or vice versa, very quickly. And that picture reminds me of, just an aside, a friend of mine when I was in the Air Force had a picture of an eagle like that, and the caption was, "I am smiling," and I almost put that in there, but I couldn't resist that one. Okay, so here's your typical butterfly. The P&L line becomes less flat over time, as I said, and it's more curvy. And curvy is a good way to understand gamma, because gamma is the acceleration of the price. So as your line is flat, the acceleration is really small and no curvy, so it's low gamma. But as you can see, the curve's starting to kick in. That's where you're getting more gamma, and that's where the risk comes in. And say you had your profit was up here, you had a big move in the market, it could now be underwater. So, versus a P&L like this, it'd just be a very small change in price, versus here be a large change. So that's kind of the problem that butterfly traders have. If you get your profit up in here, do you take it, or do you try and squeeze out the rest of this big tent? So what's the solution? There are no perfect adjustments, but there are some things you can do. Before you can understand how to adjust, you have to know how time decay behaves. And I shamefully stole some of this from Mark Sebastian's presentation about 4 years ago. So if you're watching, Mark, I'm giving my credit to you for this. So, okay, so we've all seen this standard time decay chart for options, and that's been around for a long, long time. But that chart is misleading, and the chart is for time decay for the at-the-money option only. The out-of-the-money options have a different time decay, and a little misleading, like the advertising can be misleading sometimes. So time decay is more linear for out-of-the-money and in-the-money options, and you can see this at-the-money, the black line, is fairly similar to that chart that we saw before, and the in-the-money and the out-of-the-money are basically parallel, with the extrinsic value or the intrinsic value of the option being the difference. And here's a three-dimensional chart of theta that I found that looked actually pretty nice. You can see at the money it has that nice steep decay that we're looking for. the far out of the money is pretty flat. It doesn't decay very much. But the ones that are a little out of the money or in the money, they have some decay initially, like say this one, for instance. It's decay, but the decay is slowing down. And if you think about it, it makes sense because, if you get down to your time premium of, say, a nickel or 10 cents, it can't decay very much at that point. So these options are actually, decaying faster initially, and then their decay kind of slows down versus the at the money, which has a different time decay profile. So,
Mark,
go ahead.
Mark Zurich is the professor at Columbia Business School who teaches derivatives, and that graph that you end up using, he uses all the time. I've had several friends that have taken his class there, and he actually holds up a piece of paper and like folds it with like 3 fingers, almost the way you would an airplane, because it really ends up showing how things end up decaying at the money and where the value is, and how as you get closer to expiration, it's much steeper, whereas if you go to the top end of that graph, it's much flatter than it is. So once you end up understanding the process of it, it's a perfect graph to realizing where things will decay.
Yeah, and the 3D. Oh, I guess Jim, they're saying that your sound is kind of hard to hear. Let's see. Oh, and I see Dan Harvey's here. So let me just pause for a second and see if I can get Dan in on the call. So where is he here? Sorry about that. A lot of people to scroll through. Okay, where is it now? Oh, you know what? Maybe I can just search for it. Oh, there he is. Okay. Okay, Dan, there you go. So, yeah, this is, I thought, a really good chart for showing the time decay. And like Jim said, the people that teach this use this kind of model. So a three-dimensional chart is actually the best way to think about it. And there is a link at the bottom here. It's kind of long, but just search for some of these keywords in here, mathematicaoptions.htm. I'm sure you can find it. Okay, so as we said, time decay is more linear for out of the money and in the money options. And the farther out the option is, the more time decay happens farther from expiration. And as you approach expiration, these options have little time decay. And I think Paul Demers kind of pointed this out with his trades that start out pretty far out in time, like 75 days, that he was getting more time decay sooner than he predicted. Like what option view would tell him, it was actually happening faster. And I think this is kind of the phenomenon he was actually experiencing. Okay, so what happens to a butterfly as it makes money? The wings are losing value quickly. Once the wings decay to a very low price, they're not hedging the butterfly. And Mark Sebastian talked about units, and those are, options that basically the Greeks don't make any sense anymore. Like, a 5 or 10 cent option, what do the Greeks really mean for that? The positive gamma from these wings is reduced, causing the T+0 line to start becoming more curved. So what can we do? How can you capture profit, reduce risk, and still keep your potential for increasing your existing profit? Well, let's go through an example. So I went to SPX on July 31st of this year and just put on just a sample butterfly, and here's the risk graph looks like. And then in 1 week later, it was up about $5,000. And if you're not familiar with option view, it's down here at the bottom. And that's what our P&L looked like. So how could you protect this profit a little bit and still keep some profit potential in the trade? So the story, and Dan, are you called in yet? Looks like you are.
Yes. Good afternoon, Tom. How are you?
Hey, Dan, nice to have you here.
Oh,
thanks. I know Mark and you and Mark were talking about butterflies, and I guess over time the butterfly was becoming profitable, and you would buy in the shorts of the butterfly and sell them farther out. So Mark called this the standard Harvey. And then we can just go through a quick example of this, where you would take the at the monies and roll them further away, which did reduce the margin and cut the Greeks down a bit. And that's what the resulting chart versus the original one would look like. And then, you do have some of the benefits. The margin's reduced, the Greeks are reduced, T+0 line smooth. And then Mark had suggested moving the longs in versus the shorts out, because he didn't like to buy in those expensive options, or the reverse of what you were doing. So he dubbed it the Reverse Harvey. And sorry about the picture. I don't know if that's okay, but it's kind of the reverse. There's a mirror image of you there, so it's a Reverse Harvey. So what does it do? Now, back 4 years ago when Mark presented this, he was waiting until the butterfly was profitable, but you told me on the phone now that you don't even necessarily wait for that, and maybe we can go over that a little bit later. But the Reverse Harvey is a money capturing adjustment, or also a T+0 smoothing adjustment, because it's changing the gamma. As the butterfly makes money, the wings are losing their value, like we said. So as the wings decay to those units, they're not really hedging anymore. So if you move the wings in towards the center, you're adding more gamma back, and you're still keeping a lot of your decay. So the couple of steps that Mark had was get profitable. And again, you don't necessarily have to be profitable, because this adjustment can help your trade in other ways. Sell the wings and buy new wings closer. Stay in the trade if the new trade is still in the tent. That's what his guideline was. But again, if if you're happy with the trade and you want to try and make a little more, that's kind of a trader's choice. And if you leave the tent, normally you can exit, but again, you don't have to. It's up to you. And when your profit targets reach, either exit the trade or make the trade super tight. So here's how it actually works. So we're taking these long wings and we're rolling them in towards the short strikes. And notice how much the margin's reduced this time, 24,000 down to 8,700. And the Greeks, where theta gets cut down quite a bit, but so does their gamma and vega, and the delta has not really changed too much, but it is a little bit better. And here's the graphic that shows how the margin has reduced quite a bit, and our max potential profit is still pretty good, pretty reasonable, and it has that smoothing effect, and it widens out your break even. So it makes the trade able to tolerate slightly bigger moves and still not lose so much money. Now, Dan, how would you use it these days with with the trade not necessarily being profitable?
Certainly it works very well when you do have some profit in the trade, and that is perhaps the main utility of this type of adjustment. But as you mentioned earlier, it's really a T+0 smoothing type of adjustment. And I'll give you an example. Currently, well, as you know, Tom, I've been traveling quite a bit since my daughter and I came to see you and Gabby in Paris. And so I was on the road for about 10 days, and then we'd also been traveling here locally in California to Tahoe and elsewhere. So I knew I was going to be on the road for at least a month on and off, so I didn't want to have any sort of other trade that would require a lot of adjustments that needed to be done on the spot. So I put on what I call my road trip trade, which is, there's lots of variants of it in this community and other communities, but it's basically a long-dated, bearish-leaning butterfly broken wing, and it is really bearish-leaning. So as you might imagine, with the recent run-up in the market, I've had to do something on the upside, even though the curves are relatively flat, and it's possible to make some money on the upside even if you're far outside the right break-even of the tent. But you do reach a point where you have dwindling prospects of profitability. So by rolling down your top long put, because I do these on puts, by rolling down the highest long put, that is the Reverse Harvey, as it's been dubbed, you capture some credits, you raise the right side of the T+0 curve, you'll often improve your theta just a little bit, you definitely will improve the delta, you will change your gamma just a twizz, but not enough to hurt anything. The only downside is you will be slightly shorter vega, but this is not usually a factor here. So as you mentioned, Tom, it's it can be utilized as a T+0 line type of adjustment.
Right. And just as a visual for if people didn't understand what you're talking about, on this blue butterfly, you would be rolling this strike down, which would lift this side up.
That's exactly correct, yeah. And you can do this, and yes, Ray, you're exactly right. You will raise your margin, but most of these butters, even the broken wings, are not margin intensive if you have some decent wing widths. They're not really margin intensive, so jacking up your margin a little bit to either maintain profitability or to give you a chance of falling back into the tent, I find personally it is worth that. But anyway, Tom, yeah, that's exactly correct. You raise the right side of the T+0 line, and you can do this, even if you have multiple superimposed bearish leaning butters, which I often do. I'll have, maybe an initial 6 lot or 10 lot, and then I'll add another 2 or 3 lot as the market moves up, taking care not to step on existing strikes. So I will basically have 2 or 3 superimposed butters. It doesn't really matter that much which one of these butters that you do the Reverse Harvey on. Just try it out before you pull the trigger and see what your curves and your Greeks look like. And it's a very useful style of adjustment.
Well, we have a few more slides too, so let's keep going here. So as we talked about, the margin was reduced over 50%. The Greeks were reduced, the T+0 line was flattened, and the break-evens were widened out a bit, and most of your profit potential is retained. And as Mark said back 4 years ago, the theta is temporarily reduced. As you know, butterfly, the theta keeps getting better while you're in the tent as time goes by. So as we talked a little bit about, there are other uses for this. So you can use this in any butterfly, like Dan had as a traveling trade, but it's similar to, most bearish butterflies or broken wings, M3s, Kevlars. You can even use them in iron condors and weirdors, verticals, and it can also help reduce the whipsaw effects in the market by adjusting the threatening stop by kind of flattening things out a bit. So I just put together a short iron condor example. So here's a normal iron condor, which is really just a wide butterfly if you think about it. And after a week or so, or 9 days later, RUT was down a little bit. The trade was profitable, looked like this. And then we reverse Harvey the longs and bring them in a bit, and the margins cut from 16,000 down to 7, quite a bit. The Greeks are also reduced. You still have some good positive theta, but your vega, gamma, and deltas are all better. And if you take a look at visually, you can see you do give up a little bit of profit, but the risk is drastically reduced, and your T+0 is smoother. Now, I did an experiment where compared to doing with the reverse Harvey and without the reverse Harvey, as the market moved another 20 points down. So with the reverse Harvey on, this Iron Condor was still profitable. It was still up $800. The delta was getting pretty high. And I think, in your words, Dan, this would be on the slippery slope. So you definitely want to be doing something at this point, but you're still up money. If you hadn't done the reverse Harvey, you'd still be up a little bit of money, 170, probably cover your commissions, and your delta is almost double, not quite double. But you can see you're not quite in as good a shape as with the reverse Harvey, because you didn't have that smoothing effect. And here's just the numbers comparing them next to each other. That that margin is really reduced. Your profit's much better off, and you're basically trying to kind of temper the market and keep that T+0 line flat. And in summary, so use at-the-money theta decay to your advantage. And the reverse Harvey, it's a great tool to use for adjusting, but it's not the only tool. So, it's just one thing in your toolbox. And like I said, it's not restricted to butterflies. You can use it anywhere you have verticals. And it can help you retain profits or even help you reduce losses if you're in a trade you're struggling with and the market's moving around. You can reverse Harvey a bit and try and flatten that T+0 to help cope with the market. Dan, you and I were talking. I was thinking, doing things like a weird or, if you widen out the strikes for the put credit spread, then that would give you more of an opportunity to reverse Harvey the weird or. And you had some good comments about the difference of using the standard, say, 20-point wise on a RUT versus making it wider, how that would affect the trade.
Yeah, I can't exactly remember what you're referring to, but certainly that will increase your risk, while at the same time will either reduce the number of contracts that you would need to make the same amount, or if you wanted to make more money, if it worked out, obviously widening the spread works. But since you do incur more risk, you need to be prepared to do something very quickly, and that may mean doing something with your long puts. If you get on the upside, and if you have a debit spread in place, you can either roll up the short leg, or you can roll down the long leg and take a little of that money out. So there's a lot of flexibility here, and like some of my former students used to hear me say, probably ad nauseum, you have to always think in terms of probability. I mean, we are basically controlled and disciplined gamblers when we put on an income trade. I mean, that's the definition really when you think about it, because we are making a bet that the market is going to go back and forth within our standard deviation range that we have chosen, 1 or 2, whatever it is, during the life of the trade. I mean, that is the bet. And it is a controlled bet. It's not like playing blackjack, but still the market needs to behave in this manner for you to make any money. So whenever you make an adjustment, theoretically or conceptually, what you're trying to do is to stay within the parameters of your controlled bet. And so that's where bringing in the wings or whatever you choose to do, that is where it's going to help you.
And we did have a question from Ron. He asked any reverse Harvey triggers based on ballpark figures of price of each option. I remember Mark, this is 4.5 years ago, was mentioning when when an option price gets down to about $2 on SPX, he was looking to reverse Harvey it. But I think, I don't know if there's necessarily a guideline, but it's kind of trader's choice of where you feel that option, the gamma is not helping you enough and you want to cut your margin or what your outlook on the market is. But again, 4.5 years ago, Mark was using $2 on SPX.
I think it's going to end up depending a lot, too, on the type of trade you end up having. If you're doing a bearish butterfly, a broken wing butterfly, like Dan, like you were talking about, the way I ended up trading the Kevlar, you're going to have different requirements on how you end up doing that reverse Harvey. And it also depends on how you, like, I don't know if you ever do this, Dan, but what I'll do is in my butterfly, when I'm doing a broken wing bearish butterfly, I have challenges like we all had over the last couple of weeks moved up. I'll end up taking my shorts at the center of my butterfly, and I'll roll half of them up, and then I'll roll my long put at the bottom of the butterfly. I'll roll that up also. So it's kind of like a half reverse Harvey and a half, forward Harvey. But what it ends up doing, it has the same effect of taking the butterfly. It makes it into a split strike or an iron condor. At that point, but it also ends up reducing the margin quite significantly while end up helping all of your Greeks also.
Yes, and I will do the same thing, and or certainly something similar to that. If you have superimposed 2 or 3 butterflies, of course, like every other similar type of income trade, you wind up with basically an inventory of strikes, and you have a lot of flexibility in terms of what you can do. And in fact, if the market runs up a lot and you're getting short more deltas than you want, and you still have a low gamma and relatively low short vega position, you can simply sell a put credit spread. I mean, there's lots of different there's just a lot of flexibility when you have butterflies or when you have an inventory of butterflies. And so the main thing to do, and many people sort of have some difficulty with seeing exactly what they should do, but the main thing is to study the graph. And when I say the graph, I mean the day step graph. The expiration graph is probably not going to help you too much. So if you're using Thinkorswim, put up the 4-day step and set the long-dated curve so that it would be roughly the date that you would plan to take this out. And you'll see immediately what your relative risk is.
Tom, if you pass me the ball, I have an example that I already set up. If you want to, I can show that.
Oh, sure. Okay, you've got the presenter role. Okay, we can.
Can you see that?
Yep.
So this is a regular butterfly. It's not it's an iron butterfly, but the wings are. I have all these here. I did a video on this this morning on an update, where I went through it in detail. But if I out all of the extra things, what you can end up seeing here, it's bearish butterfly. I have a couple of calls in it to end up keeping my Greeks all in line, keeping my T line. And one of the things that I'm worried about is what happens if we end up moving forward. So the example I'll end up showing you down here is that if I wanted to end up rolling and buying a call vertical, I could end up buying a call vertical here to end up rolling my short call. Remember, it's an iron, so I have a short put and a short call here. I could end up rolling up my call, but sometimes that ends up increasing my risk and it increases my margin. So instead of rolling this up 15 points by itself, what I'll look to end up doing is that I'll roll this up 15 points, but I'll also roll my long put up 15 points. So the way I end up putting that in is in a condor. And so if you take a look at the Iron Condor, I still end up rolling 15 points up here. I ended up helping my Greeks a little bit more, but I reduced risk. I didn't end up increasing risk. So, whether you do it in irons like I use, you have to buy the Iron Condor to end up doing that. If you end up doing it in just straight puts, what you'd end up doing then is that you would basically sell a Condor. Okay, you wouldn't end up rolling that up. And so it's always a way when you take a look at things, as Dan said. It's controlled gambling. So you always have to look and see where you're going to end up losing money. The only comment, Dan, by the way, I didn't agree with was the blackjack comment. If you can find a 2-deck game where they'll let you count, and I agree with you completely.
Yeah, but you have to look. You have to look very hard at the Tahoe casinos anyway. I don't know about Atlantic City or Vegas, but you have to look very hard to find the 2-deck. And also, I'm not a good card counter, but you're absolutely right, Jim, about everything that you said, and that's one of the reasons that I referred to basically all the butterfly variants as the Forrest Gump trade. If everybody remembers the movie Life is like a box of chocolates, well, you never know what you're going to get. And with a butter, you never know what your profit's going to be. It might be 5%, it might be 20%, but if you manage the trade skillfully, you shouldn't lose much, if anything.
Yeah, definitely. I love the concept of that below the money, because you know what ends up making it, because over the last 4 or 5 years, the put skew, the implied volatility of the puts below the money has gone up significantly compared to the implied volatility of the calls above the money. And so what we're all doing here is we're trying to sell the meat, right? Those highly expensive puts in that maybe 3 to 6% of the money range. How do you end up selling them? And everything else we end up doing is managing risk around that. So.
Well, thanks for sharing, Jim. There's not many more questions, and it's a fairly simple adjustment, so we don't need to go a whole hour for this. But I do want to point out that Brian Larson's Rhino trade, which is also this type of trade, and you could use Reverse Harveys in that. He is in his trial right now, and he's going to be starting his paid service pretty soon. So I put a link into the chat that if you do want to keep following Brian's Rhino trade, that we're going to have like a charter discount for everyone, and it's about 16%. So if you just go to that URL, you can see more about it. I just wanted to mention that before we go. But Dan and Jim, thanks so much. Do you have any last words to add?
I think you said it all, Tom. And thanks, Jim, also for your comments. Good to hear you as always.
It's good speaking to you, Dan. I hope everything's been going well for you.
Well, I go and find, for me, and I hope the same for you.
Time unnecessarily, so we'll keep it short today. And thanks again, everyone, for participating, and Dan and Jim especially. And we will see you next time.
Thanks, Tom.
All right.
Thanks, Tom. Bye-bye.